The S&P 500 is finally bouncing. After suffering its largest drawdown since 2022, we're finally seeing the US stock market show some sign of relief. But this comes after the index broke down below all of its key moving averages. This is something you also saw in January of 2022, right at the start of the 2022 bear market. You also saw the S&P 500 slice through its moving averages right at the start of the COVID bear market, and not to mention 2007, where the S&P 500 broke below its key moving averages right at the start of a 60% decline in US stocks. In all of these cases, the stock market bounced, but was unable to recover above the moving averages, and price ultimately headed lower. So with the S&P 500 bouncing today, now is more important than ever to ask the question whether this bounce can last and take the market back up above the moving averages and head back towards all-time highs, or whether we should be using this as an opportunity to get defensive, reduce our exposure to US stocks, and prepare for additional market volatility. We've been of the opinion that this is going to prove to be a buying opportunity for US stocks, but the key to success in trading is having a flexible and open mind. Don't be afraid to change your opinion if the data changes. So we went back through history and took a look at all of the moments where the S&P 500 was able to successfully recover back above its key moving averages. We wanted to know how to spot the difference between these recoveries that led to significant more upside in the months ahead and these failed attempts where the stock market's bounce was actually an opportunity to sell US stocks at a better price before a larger drawdown occurred. What I'm going to share in this video is going to be shaping our allocation strategy at Bravos Research. We took advantage of the bull market throughout 2024, but we want to make sure that we're managing our risk against a potential larger retracement on stocks. By the way, there's currently a 30% discount on our service for St. Patrick's Day. In 2024, we had 85 winning trades averaging 16.65% gain each, and only 44 losing trades that averaged a 3.67% loss. With a 5% allocation per trade, that's about a 65% gain for 2024, which is 2 times the S&P 500's return over that same time period. We are very proud of these results that very few fund managers can actually achieve. Although the first part of 2025 has been choppier than last year, our mission at Bravos is to make sure that we're making every one of our clients as profitable as possible in markets. It's what we do day in, day out. So if you want to have access to all of our trades along with videos showing you everything I know about financial markets throughout the week, all for a ridiculously cheap price, well, now is the time to click the link in the description below. There is one thing that all of these successful stock market recoveries have in common. In each of these, home building stocks were performing well. Now, you might be wondering why we're talking about home building stocks. This is one of the few secret formulas that exist in financial markets. Home building companies are closely tied to activity in the housing market, and this is a part of the economy that is extremely sensitive to the economic cycle and can provide us with accurate predictions of what to expect next from the economy. If home building activity is declining, it suggests there is less demand for homes. Buying a home is one of the most important spending decisions of people's lives. If there is reduced demand for homes, it increases the odds that people are going to be pulling back on spending elsewhere in their lives. After all, if they're not able to save up for a home, they're probably not going to be increasing their spending in other areas. That's why home building stocks are such a powerful tool to understand if we're experiencing underlying economic strength or weakness. The famous investor Stanley Druckenmiller notoriously uses home building stocks as a market forecasting tool. Let's take a look at this recovery from November of 2023, for instance. After the S&P 500 broke through all of its key moving averages, the index was able to snap back above all of them, and that ended up leading to a massive stock market bull run over the next 12 months. When you look at what home building stocks were doing during that recovery, they were outperforming, confirming that you had underlying economic strength and that you could expect the stock market to continue moving higher. Let's take a look at this breakout above the moving averages in early 2023. After the index made multiple failed attempts at breaking above the moving averages, this breakout ended up leading to a huge bull market over the year that followed. Again, if we look at what home building stocks were doing during the breakout, they were outperforming, confirming the strength of the rally on the S&P 500. Now, rewinding a little bit further, the big breakouts of the S&P 500 in 2020 and in 2019 above its key moving averages, both of these breakouts were confirmed by the home building sector that was outperforming. And again, if we look at all of these recoveries with the S&P 500 regaining its moving averages in 2011, 2012, and 2016, during all of these rallies, the home building sector was outperforming, confirming that you had economic strength. But let's compare that, for example, to this failed rally in 2015. Here, the S&P 500 attempted to break back above the moving averages, trended around them for a couple months, and then the S&P 500 plunged back down for another 15% correction. This rally right here was an opportunity to sell the stock market. And look at what home building stocks were doing during that entire period. They were underperforming significantly, suggesting the economy was experiencing underlying economic weakness. We can say the same thing about these two failed attempts in 2018. Both of these rallies in October and November of 2018, price attempted to break back above the moving averages, but ended up failing and heading back lower. During both of these bounces, the home building sector was underperforming, suggesting underlying economic weakness. Let's do one more example in 2022. After the S&P 500 broke below all of its key moving averages, the index then made two attempts to try and regain its uptrend. As you can see, both of these attempts failed, with the stock market declining significantly from that point on. During both of these rallies, home building stocks were underperforming to a significant extent. Investors paying attention to the home building sector during these rallies would have used these bear market rallies as an opportunity to reduce their exposure to the stock market and potentially even short the stock market. So now you might be wondering, what are home building stocks doing today on the current stock market bounce? Well, unfortunately, home building stocks have been underperforming, at least for now. In fact, home building stocks have been underperforming since about September of 2024, warning this entire time of economic weakness, and for now it does not seem like they're telling a different story. Now, some of you watching this might be confused with the recent videos where we highlighted that we're actually optimistic that a recession is getting pushed out to 2026, which could mean a strong stock market performance throughout 2025. And we're actually getting more and more data points supporting that. This is a chart, for example, showing us the percentage of small businesses that are saying it's a good time to be expanding their operations. Just over the last few months, we've had quite a considerable jump in the number of businesses looking to expand. If we add recession bars on top of this chart, we can see that heading into recessions, you typically see the number of businesses looking to expand go down, which makes sense. As less businesses are expanding their operations, they're more likely to lay people off, which could end up sparking a recession. Today, the outlook for expansion is coming up from very low levels, which is typically something you see outside of economic recession. That being said, the current breakdown that we have in the stock market is due primarily to uncertainty around economic policy, not necessarily by recession concerns or real economic weakness. Once that uncertainty dissipates, it could lead to an exceptional market rally. But as of now, unfortunately, we don't have strong evidence that short-term market volatility has come to an end. And before we get solid evidence of the market recovering, we'll likely be adopting a more conservative and defensive posture at Bravos Research. Again, don't miss the discount that we're doing if you want to have access to our service at a ridiculously cheap price. I look forward to seeing you on the website. See you next time.